Hello, everyone. In this video, I will walk you through the homework problem from topic 7. Now, this homework problem, as I mentioned in class earlier, is not reflective of an exam question. It is a very comprehensive example of consolidation after acquisition date. Uh, my intention in putting together this problem was to try to put in one problem a whole variety of adjustments that you might encounter in a consolidation situation. So this problem, if after considerable practice, you're able to complete in about an hour and a half, hour and 40 minutes thereabouts, you're doing really well. So I'm going to walk you through the problem first. So the facts are that on December 31st, 2001, the date of acquisition, Pinocchio Limited purchased 75% of the 600,000 outstanding common shares of Sirocco Company for $6 million in cash. On the date of acquisition, the shareholders' equity of Sirocco consisted of $2 million in common shares, $5 million in retained earnings. On this date, Sirocco had inventory with a fair value $50,000 lower than carrying amount. In addition, Sirocco had equipment with a fair value that was $120,000 greater than its carrying value. The equipment had an estimated useful life of 8 years on December 31st, 2001. Finally, Sirocco had an unrecorded patent worth $90,000 and a useful life of 6 years. Sirocco's long-term liabilities included bonds payable issued at par, $1 million, paying annual interest at 6%. The market interest rate for similar bonds on the acquisition date was 5%. Now, even though the bonds had been issued originally at par, considering the fact that the bonds pay an annual interest of 6%, whereas the market interest rate is 5%, you will expect that the fair value of these bonds would be different from the carrying amount. We need to calculate the fair value of the bonds payable liability using the market interest rate of 5%. These bonds are due December 31st, 2008. Finally, Sirocco had goodwill valued at $500,000 on its books. We know that if there's any goodwill on the books of the acquiree, the subsidiary, that goodwill is written off against its net book value when calculating the acquisition differential. So if we look at the calculation of the acquisition differential here, well, first off, the acquirer is Pinocchio, and the acquisition cost of 75% of Sirocco is $6 million. Considering the cost of 75% of Sirocco's shares being $6 million, we get an implied value of 100% of Sirocco equaling 8 million. 6 million divided by 0.75 gives us $8 million. The difference between the parent's acquisition cost and the implied value is non-controlling interest on the date of acquisition. Now, this $8 million is first allocated to the net book value of Sirocco. The net book value of Sirocco will consist of the common shares, 2 million, the retained earnings, 5 million, minus $500,000 in the goodwill that Sirocco has on its books. So that works out to $6.5 million. $8 million implied value minus the net book value of 6.5 million gives us an acquisition differential of $1.5 million. This is allocated to fair value differences. And in the problem, we saw the fair value differences were related to inventory, equipment, a patent that's unrecorded, and the bonds payable liability. So the inventory, we're told, is overstated by $50,000. The equipment is understated to a tune of $120,000. The patent is unrecorded, i.e. completely understated by $90,000. For the bonds payable, the carrying amount is the par value of $1 million. We need to calculate the fair value of these bonds. The date of acquisition is December 31st, 2001. The bonds are due December 31st, 2008. So from 2001 December to 2008 December, we are talking about a 7-year life, 7 years remaining. So we have a face value of $1 million. These bonds pay an annual interest at 6% of $1 million. That's $60,000 annually. 7 years remaining, and the market interest rate currently is 5%. So given that the bond coupon rate is 6%, whereas the market rate is 5%, we know the bonds would have been trading at a premium. You calculate the present value, we get 1,057,864. This PV on the date of acquisition is the fair value of the bonds. The carrying amount is $1 million. We have an understated liability. The understated liability is a negative. So 57,864. The total of the fair value differences adds up to 102,136. The acquisition differential is 1.5 million. That leaves us with goodwill of 1,397,864. The next step is to prepare an amortization schedule. So for the amortization schedule, we list the items, so inventory, equipment, patent, bonds payable, and goodwill, and we copy the amounts from above. So inventory had a negative 50,000, equipment 120,000 positive, patent 90,000 positive, bonds payable negative 57,864, and the goodwill 1,397,864. And because we are applying the fair value enterprise method, out of this $1.5 million amount, 75% is attributable to the parent, and the remainder goes to non-controlling interest, giving us a total of $1.5 million for the acquisition differential. Now, inventory is a current asset. So being a current asset, any fair value difference on the inventory is assumed to be amortized within a year from the date of acquisition. So 1 year from the date of acquisition would be the end of 2002. The problem requires consolidated statements for the year ended December 31st, 2006. So that's considerably later than the date of acquisition. So we will, in the amortization impairment box, we'll have two columns. One that keeps track of the amortization of the fair value differences up to the end of the previous year. And then another column, the amounts pertaining to the current year, 2006. And then the final column is the unamortized balances remaining at the end of 2006. So the fair value difference related to the inventory clears out within a year. So certainly the $50,000 has cleared out. The equipment had, we were told, on the date of acquisition, 8 years remaining. From December 31st, year 1 up to December 31st, year 5 is a period of year 2, 3, 4, 5, 4 years. So 120,000 is to be amortized over 8 years. From December 31st, 2001 up to December 31st, 2005 was a 4-year period. So we will have amortized this $120,000 to the tune of $60,000 by the end of 2005. For the year 2006, another 1/8 of 120,000, 15,000 would be amortized, and we will have the balance remaining of $45,000. The patent on the date of acquisition had a remaining life of 6 years. So 90,000 divided by 6 gives us $15,000 of annual amortization. 15,000 times 4 years is $60,000 to the end of 2005. Another $15,000 for the year 2006, and a remaining unamortized balance of $15,000. Now, with regards to the bonds payable, under IFRS, we should use the effective interest rate method. As I explained, for the purposes of this course, we will take the simpler approach of using straight line amortization. For those who are interested in the effective interest rate calculation, I have prepared an alternative solution, which actually does go into the nitty-gritties of using the effective interest rate. So essentially what happens in that case is the bond liability, the bonds payable liability, we prepare an amortization schedule starting with the PV computed on the date of acquisition using the market interest rate of 5%. So we prepare a bond amortization schedule using a 5% rate. So interest on the bonds is calculated at 5%, with the difference between the cash and the interest being the amortization of the bond premium. For purposes of our course, we will just use straight line amortization. So the bonds had a remaining time to maturity of 7 years. This $57,864, we'll assume that it is amortized over 7 years on a straight line basis. So 57,864 divided by 7 times 4 years gives us $33,065 amortization up to the year 2005. For the year 2006, it's 1/7 of 57,864. Again, these are numbers rounded to the nearest dollar, and we're left with a balance of 16,533 credit unamortized. Now, with regards to the goodwill, goodwill is not amortized, but rather is tested for impairment. So we're told that okay, right here, each year goodwill is evaluated to determine if there's been an impairment. Goodwill had a value of $500,000 at December 31st, 2003, $300,000 at December 31st, 2006. Now, if we began with a goodwill amount of $1,397,000, and if the balance of the goodwill value was supposed to be $500,000 at the end of 2005, then from December 31st, 2001 up to December 31st, 2005, the difference between $1,397,864 and $500,000 is the amount of impairment. So basically, take the starting balance of goodwill and subtract $500,000, the balance of goodwill at the end of 2005 to get the goodwill impairment losses up to the year 2005. And then given the fact that the goodwill has an ending balance of 300,000, you have $200,000 of impairment losses for the year 2006. It may be worthwhile to make a T account for goodwill to keep track of the impairment losses. So anyhow, we get these vertical sums now and the amounts attributable to the parent company and to NCI. Next up, we identify intra-company revenues and expenses. So in the problem, we're told in the year 2006, so now this is important, we are interested in the year 2006, but during 2006, Sirocco sold merchandise costing $200,000 to Pinocchio at a profit of $80,000. So the sales value is 200 plus 80, 280,000. And also in the year 2006, Pinocchio sold merchandise to Sirocco for 480,000. So there's been both an upstream sale as well as a downstream sale of inventory. So you have intercompany sales, cost of goods sold for elimination, 280,000 plus the 480,000 for a total of $760,000. Now, intercompany dividends. During 2006, Sirocco declared and paid dividends of $1 million. Of the $1 million dividend paid by Sirocco, 75% would have been paid to Pinocchio, the parent company. So that's the intercompany dividend amount. Dividends from Sirocco, 75% of $1 million, $750,000. And thirdly, Pinocchio provides management services for various projects operated by Sirocco. For the year 2006, the amount charged was $30,000 a month for a total of $360,000. So we have 30,000 times 12, $360,000. That's the management fee, revenue, and expense. Step 5 is the identification of accounts receivable, accounts payable. So we're told Sirocco owes Pinocchio $100,000 as of December 31st, 2006 for the inventory purchases. So that's an amount owing. I missed this piece in the solution that I posted. I'm glad that I'm doing this video. For the management services, payments are made on the 15th of the following month. So each month, the amount charged is $30,000. So if the fiscal year runs from January to December, the management fee for the month of December of 2006 would not have been paid at the end of 2006 because the amounts are paid on the 15th of the next month, or the next month following December of 2006 is January. So as of December 31st, 2006, $30,000 would have been owing for the management fees. So the ARAP number should be $100,000 for the inventory, $30,000 for the management fee. So this number should have been $130,000. Okay, so $100,000 for the inventory purchases, and that's per point number 3. Sirocco owes Pinocchio $100,000 for inventory purchases. And then, of course, the management fee of $30,000 for the month of December is not paid yet because it'll be paid by the 15th of January next year. So total ARAP for elimination is $130,000. Next up is step 6. Now, step 6 is very comprehensive for this problem. And that's one of the reasons why I use this problem. I have tried to give you information about the intra-company profit amounts in as many different ways as as I could think of. So if you read information 1, in the year 2005, which was last year, Sirocco sold merchandise costing $160,000 to Pinocchio for $220,000. So you're given the cost, you're given the selling price. You can calculate the profit by subtracting the cost, $160,000, from the selling price, $220,000. That was the total profit. Out of that $60,000 total profit, Pinocchio sold $60,000 of the merchandise, 60% of the merchandise, to unrelated third parties in the year 2005. So 60% of the total $60,000 of the profit will have gotten realized in 2005. So what was unrealized at the end of 2005 is 40% of $60,000. Now that unrealized ending inventory profit from 2005 would have been carried forward into 2006 as the beginning inventory profit for the year 2006. That beginning inventory profit will be realized in the current year. Okay? So realized beginning upstream inventory profit is 40% of $60,000. So this is the upstream amount. 40% of 60,000, 24,000. The tax is 40%, so 9,600. After tax, we get $14,400. Now, if you read on, in the year 2006, Sirocco sold merchandise costing $200,000 to Pinocchio at a profit of $80,000. So the profit amount is explicitly given in this case. Cost was $200,000, the profit was $80,000. Of this merchandise, 60% remains in Pinocchio's inventory. So Pinocchio sold the other 40%, which is realized, but what's not realized is the 60% of the inventory that remains unsold. So 60% of this $80,000 profit is unrealized for the year 2006, and it's the upstream amount. So unrealized upstream ending inventory profit, 60% of 80,000, $48,000 before taxes, the tax, and the after tax. Now, if you read point number 2, in 2005, Pinocchio sold merchandise to Sirocco for $400,000. Sirocco's 2005 ending inventory contained 30% of this inventory. And Pinocchio's gross profit margin on this intercompany sale was 40%. Margin is calculated on the selling price. So the unrealized profit in the year 2005, which became the beginning inventory profit for the year 2006, is 40% of 30% of 400,000. So 40%, 30% is the gross profit margin, 40% is the amount of inventory that remained unsold. So 40% out of 400,000 was the nominal value of the inventory that remained unsold at the end of 2005. The profit amount for that is 30%. That's 48,000 tax after tax. And then for the year 2006, in the year 2006, Pinocchio sold merchandise to Sirocco for 480,000. So that's the selling price. Sirocco's 2006 ending inventory contains 50% of this inventory, which is, again, like not too dissimilar to what we had up here. But here, now, instead of being given a gross profit margin, we're given a markup on cost. So markups on cost are calculated on the cost. So if you have a markup on cost of 60%, so if the cost price is $100, the gross profit is $60. So the selling price, therefore, becomes $160. Now, because we've been only given the sales value to calculate the amount of the intercompany profit, you need to convert the markup into a margin. Now, you folks learned how to do this in the first intermediate course, so this shouldn't be new. To convert the markup into a margin, you divide the markup by 100 plus markup. So if the markup is 60%, the equivalent margin is 60 over 160. So 60 over 160 times 480,000 times 50% is the amount of the unrealized downstream inventory profit. Right? So hopefully you'll appreciate being given the intercompany profit information in various different forms. In order to avoid having to make too many adjustment lines on the consolidated income statement, I just went ahead and added together the realized profits, the downstream and the upstream, because on the consolidated income statement, it doesn't matter if the amount is upstream or downstream. We have a total amount of $72,000 of before tax realized profits and a total amount of $138,000 of unrealized ending inventory profit. Next up, if you look at point number 6, on December 31st, 2004, so it was a prior year, Pinocchio sold equipment to Sirocco for $210,000. Pinocchio had acquired the equipment on Jan 1st, 2002 for $480,000 and had estimated a useful life of 6 years with no salvage value. So 480,000, if you divide that by 6 years, you get an annual depreciation amount of $80,000. Pinocchio had purchased the equipment on Jan 1st of 2002. So from Jan 1st, 2002 to the date of sale, December 31st, 2004, we're looking at here 2, 3, and 4, 3 years. So 80,000 times 3, the accumulated depreciation on the equipment is 240,000. Cost of 480 minus the accumulated depreciation of 240 will leave us with a net book value of the equipment, 240,000. The sale price is 210,000. In this case, we're looking at a loss on the intercompany sale of equipment. First instance that you're seeing an intercompany loss, like all this while in all of the examples, we had been working with intercompany profits. So this is an example of an intracompany loss. All right, so there was an intracompany loss. No changes made to the remaining useful life when Sirocco acquired the equipment. So the equipment originally had 6 years of useful life. 3 years had already lapsed. So you have 6 minus 3, 3 years remaining. So 3 years of the equipment's life so this 210,000 will get amortized by Sirocco over a 3-year period, and the unrealized loss basically also gets realized over that 3-year period. So here we have the sale price of 210,000, net book value is 240,000. So we have an unrealized loss of $30,000. From December 31st, 2004 to December 31st, 2005 is 1 year. So 1 year's worth of the loss will have been realized up to the end of 2005. So the amount of the unrealized loss balance on Jan 1st, 2006, $20,000. During year 6, another 10,000 will have been realized, leaving us with an unrealized balance of $10,000 at the end of 2000. Point number 7 talks about an intercompany sale of land in the year 2003, again, a previous year. The profit amount was $80,000. And with land, the intercompany profit is only realized if the land is sold onwards to an outside party. We're told that half of this land was sold in the year 2006 to an unrelated third party. So the intracompany sale occurred in 2003. From that date, no portion of the land gain had been realized till the beginning of the year 2006. During 2006, because half the land was sold to an outside party, half of the land gain got realized. So half of the 80,000 got realized, leaving us with an unrealized gain balance of $40,000 at the end of year 2006. And this was an upstream sale. Finally, if you look at point number 8, on April 1st, 2006, which is the current year, by the way, during the current year, Pinocchio sold a building to Sirocco for $900,000. The building had a net book value of $800,000 after updating depreciation date of sale. That means there was a gain of $100,000 recorded by Pinocchio on April 1st, 2006. This gain is considered unrealized on the date of sale, but as the building gets depreciated and the building had a remaining useful life of 5 years, a portion of the gain will get realized. So $100,000 is the total amount of the gain. 5 years is the remaining life. So 100,000 divided by 5 gives us $20,000 for each year. However, you have to keep in mind that the intercompany sale took place on the 1st of April and the year end is December 31st. So from the 1st of April to December 31st, we're looking at 9 months. So in the year 2006, 9 months worth of the gain will have gotten realized. So this is an interesting departure from the earlier examples that you've come across. So there is an intercompany sale of an asset that takes place in the current year. So we will have to make an adjustment for this $100,000. Then of this $100,000, a portion gets realized. So 100,000 divided by 5 gives us $20,000 for a full year. But because we were only looking at April 1st to December 31st, so in the year 2006, 9 months worth of that gain will have been realized. That's $15,000 before taxes. And so leaves us with an unrealized gain of $85,000 at the end of the year 2006. All right. So after you have dealt with the intercompany profits information, then you go ahead and calculate step 7. And step 7 is the calculation of the intercompany, well, the consolidated net income and the amounts attributable to the parent company and to non-controlling interests. So your starting point is the parent company's net income. So the parent company's net income is $3.3 million from the information. From this $3.3 million, we are going to subtract the intercompany dividends, $750,000. We want to subtract the intercompany dividends of $750,000, and then look at what occurred with regards to downstream items. So we have a realized beginning inventory profit for the downstream inventory. After taxes, $28,800. So you will add $28,800. And we have an unrealized downstream ending inventory profit of $54,000 after taxes. This will be minus. So add realized beginning downstream inventory profit and subtract the unrealized downstream ending inventory profit. And then if you look at the downstream equipment, during the year 2006, $6,000 of the intercompany loss got realized. So if an intercompany loss is realized, income should be lower. So you want to minus $6,000 for the realized loss portion. And then with regards to the building, you have to pay attention here. The building sale occurred in the year 2006. So this, first of all, you need to hold back $60,000 of the intercompany gain recorded in the year 2006. And then you will add back $9,000 of the portion realized in the year 2006. For the building, there's going to be two adjustments. One, to hold back 100% of the gain, $60,000, and then add back the portion that got realized in the year 2006. So these adjustments added to the parent company's own net income number gives us an adjusted net income amount for Pinocchio, $2,467,800. Now with Sirocco's net income, we're going to have to make similar adjustments. You start with Sirocco's net income, $1.5 million. And then you want to go and look for upstream items. So upstream items that got impacted in the year 2006. Well, we have an upstream realized beginning inventory profit after taxes, $14,400. So you want to add $14,400. And there is an unrealized ending inventory upstream, $28,800. So this amount you want to minus. So add the realized portion, the realized beginning inventory, and minus the unrealized ending inventory. And then there's the upstream land. What happened in the year 2006 is half of the land gain got realized. So you want to add $24,000 to Sirocco's net income, giving us an adjusted amount before taking into account the amortization of acquisition differential of $1,519,600, of which Pinocchio owns 75%. So Pinocchio's share works out to 75% of $1,509,600 or $1,132,200. Now, of course, this number was before accounting for the amortization of the acquisition differential. We want to take Pinocchio's share only. So if you go back and take a look at step 3, for the year 2006, the total amount of the amortization of acquisition differential amounted to $221,734, of which $166,301 is the amount attributable to the parent company, Pinocchio. This is the amount, $166,301, that you will subtract to get the consolidated net income attributable to the parent, 3,433,699. Now, since 75% of Sirocco's net income was attributable to the parent, the remaining 25% is attributable to NCI. So NCI picks up 25% of the 1,509,600, and that's 377,400. And then you want to subtract NCI's share of the amortization of acquisition differential. So amortization of acquisition differential, NCI's share is 55,433. You want to subtract 55,433 from this 337,400 to get the consolidated net income attributable to non-controlling interest, 321,967. These two amounts, so consolidated net income attributable to the parent and consolidated net income belonging to non-controlling interest, gives us the total consolidated net income, 3,755,666. So if you were to prepare a consolidated income statement, you will begin with the parent company's income statement information and the subsidiaries' income statement information. And remember that when preparing the consolidated income statement, we get adjustments from step 3, step 4, and from step 6. So step 3, for the year 2006, these were the individual adjustments. So there is nothing for inventory, but we have a $15,000 debit adjustment relating to equipment. The income statement line item for equipment is depreciation. So you will add $15,000 to depreciation expense. For the patent, $15,000 debit adjustment. The income statement counterpart for patent is amortization expense. So you will add $15,000 to amortization expense. For the bonds payable, the income statement line is interest expense. And this being a credit adjustment will mean you will subtract $8,266 from the interest expense. Goodwill, there's the counterparty is goodwill impairment loss. So you will add $200,000 to goodwill impairment loss. Now, neither company will have had a goodwill impairment loss on their own separate company book numbers. So you'll need to create a new line for goodwill impairment loss and show the $200,000 there. Now, step 4 is about eliminating intra-company revenues and expenses. So $760,000 you will eliminate, i.e. minus from the sales and from cost of goods sold. $750,000 of dividends from Sirocco you will minus from other income. And the management fees you will subtract from the other income, $360,000, and also subtract from other expenses or wherever these management fees expense have been recorded by Sirocco. Most likely it'll be other expenses. Now, for step 6, the realized beginning inventory profit, $72,000 is the total amount because we don't make any distinction between upstream and downstream when making the consolidated income statement. So $72,000 is the total amount realized before taxes. The before tax amount of $72,000 you want to subtract from cost of goods sold. If you lower cost of goods sold, your income before tax goes up. So subtract $72,000 from cost of goods sold and then add $28,800, the tax amount, to income tax expense. Similarly, for the unrealized ending inventory profits, you want to add $138,000 to cost of goods sold. When you increase cost of goods sold, the income before tax goes down. If income before tax goes down, income tax expense should be lower. So you want to minus $55,200 from income tax expense. In the year 2006, a portion of the downstream equipment loss got realized. So $10,000 of the loss got realized before taxes. So a realized loss should result in lower income. So because on the income statement, the line item relating to equipment is depreciation, you want to increase depreciation expense by 10,000. Okay, so add $10,000 to depreciation expense, but that means your income before tax will be lower by $10,000. So the income tax expense should be lower by 4,000. So minus $4,000 from the income tax expense. For the realized land gain, land is not amortized, so the realized portion of the land gain is something that you'll end up having to add to other income. So add $40,000 to other income and add $16,000, the tax amount, to income tax expense. For the building gain, now this is important because the building was sold intercompany during 2006. $100,000 is sitting as the gain on sale of building under other income in the separate company books of Pinocchio. When consolidating, you want to minus $100,000 from other income. And then because a portion of that gain, $15,000, got realized in the year 2006, this $15,000 you will subtract from depreciation expense, because the process of the intracompany gain getting realized for depreciable assets is through adjustments to depreciation. So this is vital, guys. You have to make sure that you get this. The total amount of the gain, because the intracompany sale took place in the year 2006, the total amount of the gain is sitting in other income. You want to subtract $100,000 out of the other income. And then for the amount that got realized in the year 2006, this $15,000, you want to reduce depreciation expense by the $15,000. You lower the expense, the income before tax goes up. Now, the net effect of these two adjustments is that income tax should be lower by $40,000, and then income tax should be higher by $6,000. Or you can make a catch-up adjustment. Income tax should be lower by $34,000 net for the two adjustments. So that's what we are going to demonstrate here. So from intracompany sales and cost of goods sold, you want to subtract $760,000. Then the $750,000 of dividends you need to take out of other income. Then from other income, you want to take out $360,000 for the intracompany management fees charged. Then $100,000 of the unrealized building gain on the date of sale, April 1st. And then the realized land gain of $40,000 is added to other income. To cost of goods sold, you're going to make an adjustment, $72,000 minus for the realized beginning inventory profit, and add $138,000 for the unrealized ending inventory profit. For depreciation amortization, you will add $15,000. This is if you click on the cell, it'll take you back to what the item refers to. It refers to the $15,000 of the fair value difference amortization for equipment. And then you have another $15,000, and that's the amortization expense on the patent fair value difference. So if you click on the cell, it'll take you back. That's the amortization on the patent. Then you'll have $10,000 being added because of the realized equipment loss. And finally, you'll have $15,000 being minused because of the realized portion of the building gain. Those will be a whole bunch of adjustments to depreciation/amortization expense. To interest, you're going to make an adjustment for 8,266, and that's the fair value difference amortization pertaining to bonds payable. Other expenses, you will take out 360,000. That's the matching amount to the management fees that we deducted from other income. Same amount must go out of other expenses. And then goodwill impairment loss, we had a goodwill impairment loss of $200,000. For income taxes will be higher by $28,800. If you click on the cell, you can get that is the total amount of the tax on the realized beginning inventory profits. Income tax expense should be lower by $55,200, which is the tax amount on the unrealized ending inventory profits. Then income tax expense should be lower by $4,000 because that's the tax amount pertaining to the realized equipment loss for the year. Loss reduces income, so income tax expense should be lower. Then $16,000 is the tax amount on the realized land gain. $40,000 is how much income tax should be lower because the intra-company gain on the building sale is unrealized on the date of sale. And then income tax expense will be higher by $6,000. And that's the tax amount on the portion of the building gain that got realized in the year 2006. So those were a whole bunch of adjustments that we make. And then after that, it's a matter of adding together the parent sales, the sub sales, and the adjustments. So if you make these adjustments, you get consolidated net income being $3,755,666. You can check that amount against step 7, $3,755,666 indeed. And just keep in mind that on the income statement, the face of the income statement, we have to show how much of the consolidated net income belongs to the parent company's shareholders and how much belongs to non-controlling interest. This is not optional. If you choose not to show these amounts, you will, on an exam, end up forfeiting marks. In order to make the balance sheet, we need amounts for retained earnings and non-controlling interest. So to calculate those, we begin with Pinocchio, the parent company's retained earnings on December 31st, 2006, $14,500,000. Now, from this amount, we want to subtract any downstream unrealized profits and add back any downstream unrealized losses. So as far as downstream numbers go, there's the downstream ending inventory profit of $54,000 after tax. So this number will be subtracted. With regards to the downstream equipment loss, we have $6,000 of after-tax loss remaining unrealized. So this amount will end up adding back. And then as far as the building gain is concerned, there's an amount of $51,000 after taxes. This will be subtracted. The 3 adjustments to be made to the parent company's retained earnings, minus the unrealized downstream ending inventory profit, add back the unrealized downstream equipment loss, and minus the unrealized downstream building gain. And we get Pinocchio's retained earnings adjusted, $14,401,000. Likewise, you take the subsidiaries' retained earnings. Make sure that you minus the subsidiaries' retained earnings on the date of acquisition, $5 million. we get the change in Sirocco's retained earnings since the date of acquisition. To this amount, you will make adjustments for any unrealized upstream balances. There is the unrealized upstream ending inventory profit, 28,800 after tax. And then there's the unrealized land gain remaining, $24,000 after tax. So both of those amounts we will subtract from Sirocco's change in retained earnings to get the adjusted amount of the change in Sirocco's retained earnings before taking into account any amortization of acquisition differential. So that we're going to take into account separately. So 75% of this adjusted change belongs to the parent company, 4,820,000. The accumulated amortization of the acquisition differential, the parent company's share only, works out to, so if you go back to step 3, of the total amount of amortization, the amount belonging to the parent company is 701,099 plus 166,301, or a grand total of 867,400. So that 867,400 we subtract to get consolidated retained earnings, December 31st, 2006, $17,814,000. Now, if you were to calculate non-controlling interest, you could have made use of some of this math. And in that case, what you would have done is you would have taken NCI on acquisition date. And you would have said, well, NCI on the date of acquisition was $2 million. To this $2 million, you will have added NCI's share of the change in Sirocco's retained earnings, (25% of 5,707,200). That's 1,426,800. And then you would have subtracted NCI's share of the accumulated amortization. So accumulated amortization of acquisition differential, NCI's share. This will be 233,700 plus the 55,433. So that works out to a total of 289,133. If you add up vertically, you would get non-controlling interest for the balance sheet, 3,137,667. So you could calculate NCI this way, or alternatively, you could calculate NCI using the net book value of Sirocco on December 31st, 2006. The net book value of Sirocco Company on December 31st, 2006. You'll add the common shares to the retained earnings, and remember to minus the goodwill that still exists on the books of Sirocco. That gives you 12,260,000. Adjust for the unrealized upstream profit numbers, 28,800 for the ending inventory profit and $24,000 for the unrealized land gain. Calculate non-controlling interest share, 25% of that amount, and then adjust for the unamortized acquisition differential, of which 85,867,000 belongs to non-controlling interest. So add 85,000 and change to the 3,051,800. You get NCI 3,137,667. So either way, the calculation is acceptable. And once you have all of this information, you can go ahead and prepare the consolidated balance sheet. So when making the consolidated balance sheet, you need to remember that you get information from step 3, step 5, step 6, and of course, steps 8 and 9. So steps 8 and 9 are essentially reminding us that we need to replace We just need to make sure that we reproduce the amounts calculated in step 8 and 9 for the retained earnings and non-controlling interest. And then if you go back to step 3, from step 3, we will be interested in the unamortized balances. So there's nothing for inventory. We have $45,000 debit for equipment. So add $45,000 to equipment. Got $15,000 debit for the patents. You want to add $15,000 to the patent. And if there's no line for the patent, then you need to create a line for the patent. $16,533,000 credit for the bonds payable. Well, bonds payable being a liability, when you credit a liability, you end up adding. So add 16,533 to the bonds payable liability. And then goodwill, there's no line there. You need to create a line for the goodwill, $300,000. From step 5, you will subtract $130,000 from both accounts receivable and accounts payable. And then with regards to step 6, any ending profits imply an overstated asset. Any ending unrealized losses imply an understated asset. So for the ending inventory profit, the total amount of the profit is $138,000. That's the amount by which inventory is overstated. So you want to minus $138,000 on the consolidated balance sheet. And because the tax has already been paid, you will add $55,200 to a deferred tax asset line. Deferred tax asset is a non-current asset. As far as the downstream equipment loss is concerned, there's an unrealized loss balance remaining of $10,000. You will add back the loss, $10,000, to the equipment. And the $4,000 tax amount, negative $4,000, you'll subtract from the deferred tax asset account, because that's basically the amount of tax recovery that will occur in future. Well, not quite. That's the deferred tax liability, right? Because we've already saved taxes on the intra-company loss. As in future the loss becomes realized, we will have higher income tax expense as a result. That doesn't make sense. As the loss in the future, as the losses get realized in the future, we had saved the loss. We had saved income taxes on the loss in the year of the income tax, in the intracompany loss. In the future, as the losses get realized, we will have to make adjustments downwards to that, to the deferred tax amount there. So our deferred tax asset will be lower. So here, subtract $4,000. As far as the upstream land gain is concerned, you want to minus $40,000. That's the amount by which the land is overstated, and add $16,000 to deferred tax asset. And then for the building, finally, minus $85,000 from the building account, and add $34,000 to deferred tax. So that's what we do. So we have $130,000 being taken out of accounts receivable and the current liabilities. For the inventory, we're going to make an adjustment for the $138,000 and make sure that we add the tax amounts in appropriate places. The land we need to adjust for the $40,000. For the buildings, we need to adjust for the $85,000 from step 6. Intangible assets, we'll add $45,000. Now this $45,000, where's that coming from? $45,000 is, well, that's incorrect. It should be $15,000 for the patent, because that's the intangible asset. Oh no, that was the equipment. My apologies. So the equipment is good. $45,000. The intangible assets, you will adjust for $15,000. And goodwill, the goodwill sitting on the books of Sirocco needs to be wiped out and instead replaced with $300,000 of the unamortized uh, goodwill balance. For the long-term liabilities, you will make an adjustment of $16,533. Common shares, only the parent company's common shares will be reported. The subsidiaries' common shares are wiped out. And let me see. So deferred tax, I have to include a whole bunch of taxes on the separate accounts. So 16,000 pertains to the land, 34,000 pertains to the buildings, 55,200 pertains to the inventory. And then as regards the equipment, we also had $10,000 of the unrealized equipment loss. So that gets added back with the tax amount taken out of deferred taxes. And I think that's all as far as the adjustments are concerned. Oh, there was 16,000. Oh yeah, the investment account needs to be wiped out, right? So we can't have the investment in Sirocco showing up. That needs to be wiped out on the for the consolidated balance. So if we were to go ahead and calculate the totals now, we'll get a total for the consolidated balance sheet, $50,178,200. And that, my dear friends, was the solution to the homework problem. I hope that you were able to watch the solution to the end. I know it's a longish video, but this particular problem is a very good problem to practice because it captures a lot of different kinds of adjustments. Your exam question will not be as long as this, but you don't know what kind of adjustments to expect. So hopefully this will be of help to you. This is Harjinder signing off. Bye-bye.